Hey guys, welcome back. In the last couple of videos, we dissected 3 trading charts. More specifically, we went over supply and demand, higher lows and higher highs, and we also talked about touch points in those areas. Now, going forward, it is impossible for me to go over every single circumstance that ever existed in the market so you guys have an arsenal of what to look for. This is why people have always said, and I used to hate this so much to my core, 2 to 4 years in order for you to fine-tune your lens to identify opportunities in the market. It is absolutely true. You cannot prepare yourself for every circumstance that will ever exist, but you can identify where you have a definitive edge. It definitely exists in trading. Everyone else that will convince you that trading is erratic, they are correct. However, in the erratic nature, there is a way for you to identify that edge. That's why you guys are here. Going forward, we're going to add an additional element to our trading pyramid. That's going to be the triggers themselves. So we're talking about the indicators. Just be careful with this. Don't just put on the indicator just because I'm telling you this is what I use and this is what I've had success with. You need to be able to identify what is appropriate for your psychology and your trading system. I'm a little bit more of a longer term trader. I like the 1 hour, the 30-minute, but I really like the 2 hour and the 4 hour time frame, right? That is my home base, and I recognize that about myself. That is never going to change. So if you are a shorter time frame trader, just make sure you are taking the principles and you are applying that for everything you're going to do going forward. That is my takeaway for you guys. Without further ado, let's dive into the indicators and let's really start to build this trading system from the ground up. What you are seeing on your screen is what I've made reference to for years. It is literally a trading pyramid. Whenever you hear me say architect or engineer trade, I always want you to come back to this visual. So notice, we're going to start from the bottom up, building the pyramid. And we're going to start off with what I call the pillars or the roots. Knowing your system is where it all begins. You got to know the weaknesses, the strengths, the statistics. You got to know where you dominate, where you don't dominate. If you're in a chop day, do you have an edge there? Do you not have an edge there? You got to know the intricacies and the idiosyncrasies of what you're using to capitalize on the market. If you're a scalper, this is actually more important for you. If you are a longer term trader, yes, there are weaknesses in your capitalization of the market, but they're usually not as susceptible to some of the short-term jitters that you see as a trader. Next thing is going to flow incredibly well into master invalidation. So that basically means setting your stop loss accordingly. I cannot tell you how many people I've mentored or just talked about trading with where they say, I don't know where to set my stop loss. That is the craziest thing that I've ever heard. It's kind of like you driving a car and saying, I don't know when to stop or, pump the brakes. That is just insane to me. Usually I pick up on the mistakes fairly quickly. I say, show me your last 5 trades. If I see a drawdown of more than 20, 30%, I better see a risk reward that's at least 2 to 1. If you really, really want to push the gamut, you can say, all right, 1 to 1, right? But if you have a drawdown where the risk reward no longer is in your favor, that's where you need to set the stop loss. This is the easiest mistake for me to fix. What is difficult about this is if you've been trading like this for, 7 years, and then you've convinced yourself that this is how it's always worked. You're not really going anywhere, but you're not going to change anything up. That is insane to me, right? So pump the brakes, guys. Make sure that you have the risk reward always set before taking the trade. Next, this flows also incredibly well into risk reward. This is where everything just comes together. 2 to 1 risk reward is what we recommend as the baseline. Some of you are going to say, hey, I trade with 5 to 1, 6 to 1, 7 to 1. I do as well. All right. I definitely go for the 15, 20 to 1 trades. Of course I do. But as a baseline, I use 2 to 1. You see how everything ties in with one another? Knowing your system, knowing when to cut your system off, and also knowing where to set those profit targets. Profit target is pretty easy too. If you take a trade and you're up 20%, you move up the stop loss. Now you have a break-even trade. If you start moving to 30, 40, 50%, give yourself 20% breathing room and then set that stop loss there. You don't always have to clip the wing of the trade because you don't know if it's going to be a trend day or not. A lot of you are going to say, hey, I can call out a chop day. I don't know how you do that. I have 15 years still trying to figure that one out. But if you have that intuitive sense where you know what's going to be a chop day, what's not going to be a chop day, and you decide not to trade, that's fine. I trade this way. I trade this way because it's systematic. It's something that is approachable and repeatable. So if I need to move up that stop loss, right? That's mastering the invalidation phase. I move it up and I always adhere to the 2-to-1. If I can get a break-even trade or if I can get a free trade is basically you get to 30% and you move it to a 10% stop loss. That's how it is I go about my business. If it moves up to 50, 60, 70, 80, 100, 150%, cool. I'm just moving it up and I'm trailing up the stop loss. It doesn't need to be more complicated than that. Okay, so now moving up to the foundational level. This is what we talked about in the last couple videos. This is where I went over a couple of examples on IWM, Tesla, etc. First thing you have to be able to identify as a trader. I want to make this clear. This is not a trigger per se, right? The triggers are going to be up here. These are just going to set where you need to have attention in the market. Supply and demand does exactly that. Accumulation, distribution. When we're coming into these levels, it's not because you hit 175 and there's massive, massive accumulation on Apple or whatever stock. Fill in the blank here. Just because you come into that zone does not mean you have a buy or a sell signal. The buy and the sell signal is the responsibility of the indicator. This just shows you where you need to be paying attention. If you are looking for a trade always off the 1 minute or the 5 minute time frame, God bless you. But that's not how I approach this. I approach this looking at the big levels. I call them the institutional levels. This is more particular to me. This is where I found my home base and where I'm comfortable psychologically. But if we're going to learn, we want to learn at least the foundational concepts. That's what we're doing here. We come into the supply and demand area. We come into those zones and we just want to notice how price action is reacting. If you come back down into the level and then you have a 20% jump, chasing that 20% jump is not going to help you. All right. You want to try to anticipate that. How do you anticipate that? You're going to use some of the indicators where you guys are not going to get the start of the candle. I don't know why some people think that traders get the start of the candle and they get the entire run. That is unrealistic in trading. You get a smidgen of the move, right? That's all you need. You need 2-to-1 of that move. If I'll give you a recent example, right? Tesla went from $250 to $485. If you think that traders are catching that entire move, you're out of your mind. We're catching a little bit of that move, a snippet of that move, and then we're locking in profit. That's how it works, okay? So supply and demand area, recognizing that takes some time and it takes some practice. Even myself, I always am looking to perfect this. I'm not using algorithms. I'm not using AI. I'm just using common sense. Where are we looking for the anchoring bias? How are we reacting off that zone? If I get a signal, if I get a higher low off of the overall trend, I'm looking for that higher low, right? This is really, really nice segue into higher lows and higher highs. If I'm looking at that higher low, higher high, and I have an overall trend off the 1 hour, 2 hour, 4 hour daily time frame, then I'm looking at some of the indicators to confirm, hey, I want to take this buy signal. I want to take this sell signal. That's how it is I apply these principles in trading. If I don't get it right on that demand level, right? You're going to see here in just a second. If I don't get it right on that first demand level, then I'm giving myself a second, third, and sometimes fourth chance. This is more particular to my trading strategy. Some of you guys don't use this, or you maybe never even thought of this. I get it wrong the first time, I'm stopped out, I take off the trade, but I will try again on a good quality stock. I probably wouldn't do it on Zoom, probably wouldn't do it on Peloton, but I will do it on NVIDIA. I will do it on XYZ top 550 stocks that exist in the market. I always give it another chance because I know, I'm very convinced of this, of the efficient market hypothesis. We have a tendency to range to the upside because that's what markets are designed to do. Just in case you were wondering why I generally prefer 80% of the time taking long trades. Next is going to be the 2 to 3 touches. I do not want to confuse you or conflate the fact that these are identical. They're not identical. Higher lows and higher highs is a characteristic. So when you stair step in either direction, either from high to low or low to high, those are higher lows, lower highs, etc. When you're looking at 2 to 3 touches, they are on the same horizontal plane. So they are not the same thing, okay? 2 to 3 touches, then what we have, or what we're identifying is either a double bottom or a triple bottom. Very often, that quadruple bottom will either break or just not hold. I'm not looking to take trades off of the triple bottom. I'm looking for all the other contexts that exist around that third or fourth touch. Usually, if I'm seeing a quadruple bottom, especially on the higher time frames, I'm looking at the context of the lower highs following up into that touch point. Just like I showed you on Tesla, I said that there were lower highs consistently being made. I called out the drop down to 330, right, from 370 or even a little bit higher. The reason why is not because I'm a magician or I know something that you don't know. No, of course not. It's because I identified that as we were coming into that level, all that price action, all that buying pressure just wasn't there any longer. So that fourth touch or third touch starting to break a little bit lower. So they're not the same thing. Know how to identify a trend. That's higher lows and higher highs. That's trend identification. And then also know how to identify a strong support or resistance level, or in this case, supply and demand, accumulation, distribution. I use those a little bit interchangeably. I understand the nuances there, but let's stick with supply and demand, right? I think that those are clear, very, very clear concepts. So those are the principles that we need to adhere to. So now we're flowing through this, right? We start off with here, and then we're flowing into the second level, and then now we're actually going to go to the triggers. This is bringing it to your attention, setting it up on the platform, and now we're going to discuss the actual triggers. I want to be fully transparent here. There are not all the triggers that exist that some of you are using. Some of you are using premium indicators. Some of you are using indicators from that you've built yourself. That's fine. That's totally fine. That is not what I'm trying to teach. What I'm trying to convey to you is whatever indicator you use, just know how to use it. If you're going to use it in tandem with one another, if you see someone say, hey, the RSI works really well with the OBV, or the stochastic oscillator is working really well with the voodoo lines, that's fine. Just know that the buy or the sell signal needs to be the same every time, okay? If it's different, or if you're taking triggers all over the place, it's like trying to hit a moving target, or trying to hit this is the best example ever. Trying to hit the lottery, picking different numbers every single time. You're trying to hit a moving target, and shooting in different places in the dark. Not going to work. It needs to be the same every single time. Cool? So now let's go back here. What are the most common ones? I'm only going to go over the most common ones, and I'm going to circle the ones that I use the most. Not the ones that I like the most. It's not about my preference. It's about if I can identify the buy or the sell. RSI, most of you know RSI very intuitively. The MACD, these have been around forever. This is how I learned. The moving averages. I will tell you that the moving averages are the indicators that I am using more extensively, probably for the last 8 years. The VWAP. The VWAP is a favorite of scalpers because it's very clean, very clear, and if you are using the 2-to-1 risk-reward principle, the VWAP is an incredibly clean setup. Next is going to be the anchor VWAP. I use the anchor VWAP on the larger time frames to try to catch momentum in the market. I have been very successful with the anchor VWAP. Next is going to be a Voodoo Lines. Voodoo Lines is a $2,000 to $3,000 indicator. I'm not advocating for them. I'm not telling you go out and buy the Voodoo Lines. I will just share with you why I like them and why I use them, and I think that they are advantageous for us traders. Everything in trading for me is business-wise. I made a business investment. I made my money back on the Voodoo Line indicators with just 3 trades. I will just talk about them and why it is I like to use them. But don't think that I'm trying to push Voodoo Lines indicators on you guys, because I'm not trying to do that at all. Parabolic SAR, this is another one, right? This is a form of an oscillator. You have another oscillator here with the TTM. You have the average true range as well. I know a lot of scalpers like to use this. OBV seems to work quite well. OBV, not OBR. OBV seems to work quite well for the short-term traders because it is a little bit more real-time. It doesn't lag as much as the MACD or the RSI. So this, I know, just from experience using it myself, it's fallen into favor with scalpers as of recent. Next is the stochastic oscillator. I'm going to tell you now, the stochastic oscillator, the MACD, and the RSI, even the TTM, if you put them on a head-to-head matchup, they're basically giving you the same signal, just very, very, very small or minute gyrations of where the entry is. If you're using this on the larger time frames, the 4 oscillators that I just pointed out, I'm not sure I can tell too much of a difference, right? So know your tools. Know if you're going to use one over the other. I'm more partial to TTM. If you're going to use any of the indicators or the oscillators, probably want to use that in tandem with another more cleaner, more real-time signal. That's why I like to use the moving averages, which you will see in my chart after I'm done with the explanation. Lastly, you have the Bollinger Band. This is very similar to the ATR. It's going to tell you, we're a little bit oversold here, we're a little bit overbought here. Maybe I want to take a long or a short. I think that both these indicators, the ATR and the Bollinger Band, I think that they are inconclusive. I don't think that they give you the right amount of information for the time frame. So even though I included them on my chart, I don't use them extensively. Sometimes, every once in a while, I'll throw a Bollinger Band on, but I really don't use them all that much. Cool? So the indicators that I use, I'm just going to be clear. I use something called the RAF. Those are just the most common ones, okay? Those are just most common. But indicators that I use, indicators, are going to be the voodoo lines. Then I use something called the RAF. Then I also use something called the volume profile. And then I also use the moving averages. So notice I have 4 of them on here. Let me put the moving averages on. Now for me, they're telling me different things, averages. They're telling me different things, different pieces of information at different incremental points. For the short-term trading, I use more the moving averages than anything else. I'm also using that in tandem with something called the ready, aim, fire indicator. It's just basically another oscillator. There's nothing really special about it. It is equivalent to something known as the TTM. I'm starting to get a little sloppy here with my handwriting. I apologize. But these are basically the 4 indicators that I like to use for myself. You will see why it is I use these indicators in tandem with one another. What I wanted to make clear is I put this all in my trading pyramid and my trading system. One is going to filter into another. Whatever trading stack, whatever indicator stack that you use, I'm stealing this terminology from coders. You want to stick with that for a little while. You want to use at least 2 to 3 triggers. If those triggers are lining up, then what is generally considered is that you have a little bit of a stronger signal as a buy or as a sell. Now, what I didn't tell you and what should be inferred very heavily is that I'm using the indicators with my supply and demand, S and D, S and D. And I'm also using that with higher lows and higher highs. And I'm also using the 2 to 3 touch principle. So indicators plus all this, now we're looking at possibly anywhere between 6 to 7 triggers at the same time. Cool? So now it's not a matter of just looking at one thing, but now we're looking at 6, maybe 7 things. A lot of you are thinking that's way too much information for me. The supply and demand and the higher lows, higher highs will become more intuitive. So really, these are more intuitive and these are more visual. Okay? So really what you're looking for is maybe 2 to 3. You're not looking for the voodoo line, the RAF, the volume profile, and the moving averages all to tell you the same thing at the same time. It doesn't work that way. I wish trading was that easy. It's not that easy. Not even close to being that easy. This is where you need your experience and your interpretation of what's happening on the chart in order for you to make that decision. Cool? So I hope with this explanation, it is my literal hope that you guys can see a little bit more of the broad-based picture on how we funnel through the decision making. So just some things to keep in mind. If you have invested any point in your career, you know that this is not the process of you thinking about an investment. You're looking at this completely differently. You're looking at PE ratios, you're looking at EBITDA, you're looking at financial statements. This is not the process that you need to go over. So remember, trading, not investing. We have different focuses. If you are going to trade, this is how you need to think about the process of it. Do not come at this saying, hey, I'm going to buy here, I'm going to buy a whole bunch of calls on Tesla, and you have no technical analysis to follow your thesis. You don't want to do that. It's going to be a big, big mistake. Number 2 is, this is always debated, but 1 to 5% risk on any given trade is generally what I recommend. Do I go over 5%? Absolutely. I go over 5% all the time, but it is my capital. Do what's best for you and your risk appetite. If you want to go only up to 2% and you still think that that's too much, no problem whatsoever. Know your system, know what numbers are going to favor for you. Oftentimes, if I put on 20%, I'm good. 20% of my capital, I'm good with the 20% trade on Apple or Google or whatever the case may be, 30%, because I know that if I do something like that, then I'm moving the needle for my portfolio. And I'm okay with the risks, especially if I see an opportunity. Next is going to be something that I've alluded to, but I want to make sure that I drive this point across. You have 2 to 3 demand or supply zones, and you're going to use that on any given time frame. Cool? So I had an illustration here where you obviously have a trend, and that trend has a couple demand levels. So if we start giving up some particular levels, I'm going to do this in a different color. If we start giving up some levels and then we come into this zone and we see a little bit of a jump, If I don't, or if I can't read my indicators telling me that, hey, there might be some price action that might be strong here, I might take the trade. I honestly might. But if we start invalidating, which is pillar number 2, I'm going to cut that off because the risk reward is no good. But I have another demand level that we can trade into. That demand level is going to be a little bit lower. If we do not hold that level, then I'm looking for demand level number 3. And then if demand level number 3 is not holding, then I'm going all the way back into this historic price action, where demand level number 4 might be it. Cool. So that sometimes means that I might take a trade 4 times over. I might get stopped out 3-4 times, but I'm going to keep on trying on the trade, especially if I identify that this is a good stock. NVIDIA would probably be a very good example. Or I did this on Lululemon last year. I lost on Lululemon a few times, but as soon as it started creating that little crevice and I identified, okay, this might be it. A lot of you are thinking, all right, this is a buy the dip sort of moment. There is a way to tell, especially on the higher time frames, when that moment is to come to pass. Usually it's about heightened volume. But in this very, very basic scenario, it's all about you saying, okay, it didn't really work here for this demand level, so let me try and see if there is a lower demand level and just wait for that opportunity. That's what I wanted to express. And then finally, if this wasn't apparent through my explanation, you want to consider not just the signal, but the risk reward. If you do not have the two things, then you have no trade to take. The signal needs to be there. You need 2 to 3 confirmations, and then that risk reward. Whether you're a buyer, you're a seller, if you're buying shares, doesn't matter. This is applicable to futures, to any trading methodology, any trading system that exists. Cool? These are your focus points. I think by now you guys are getting an extremely strong sense on how I flow through the decision-making process of taking a trade. We start from the bottom of the pyramid and then we work our way up. My recommendation, even before we continue and I show you all the fancy tools that I use, extrapolate what you have learned here today and make it your own. Try to modify and adjust the things that make sense to you and then make it completely personal. That is the best advice that I ever got, stealing little parts and components from other traders and then making it my own. So hopefully you enjoyed this video and you learned a thing or two, and let's dive into reading buy and sell signals.